Walk down Main Street right now, and the economy looks broken. Small businesses are closing. Credit card delinquencies are at the highest level since 2012. People are skipping meals to pay rent. Now take a walk down Wall Street. The S&P 500 is smashing all-time highs. Luxury real estate is booming. Corporate buybacks are exploding. This makes absolutely no sense, right? How can the stock market be at record highs if the actual people driving the economy are broke? Most people look at this and say, it's a bubble, it has to pop. But I'm here to tell you they are wrong. This isn't a bubble, this is a transfer. What we are witnessing is a phenomenon economists call the Great Disconnect. The market isn't going up because the economy is healthy. The market is going up because the money itself is broken. Today we are going deep. But most importantly, I am going to show you the escape plan. I'm going to break down the exact 3-part portfolio I am building to catch this wave of liquidity, so you stop being the victim of this inflation and start profiting from it. Chapter 1. The Cantillon Effect. Why the rich get richer. To understand why you feel left behind, you have to understand an economic concept from the 18th century called the Cantillon Effect. Richard Cantillon discovered a simple, brutal truth. Inflation is not uniform. When the government prints new money, it doesn't appear in everyone's pocket at the same time. It enters the system at a specific point, usually through the big banks and financial institutions on Wall Street. These people get the new money, or first. They get to spend it before prices rise. They use it to buy assets, stocks, real estate, bonds. By the time that money trickles down to you in the form of wages, prices have already risen. The rich got to buy the assets cheap with the new money. You get to pay the higher prices with your old money. This explains the disconnect. The liquidity hose is plugged directly into Wall Street. The stock market is rising because it is absorbing the new money first. If you aren't owning assets, you aren't just missing out. You are the victim of the transfer. Chapter 2. Asset inflation versus CPI, the groceries trap. This leads us to the biggest trick the government plays on you. The CPI, Consumer Price Index. The government tells you inflation is down to 3%. And you look at your grocery bill or your rent and you scream, liar. But here is the nuance. They are measuring the price of milk. They aren't measuring the price of wealth. There are two types of inflation. Consumer inflation, the price of bread, gas, and shirts. The Fed hates this. It makes voters angry. Asset. Inflation, the price of stocks, homes, and gold. The Fed loves this. It makes people feel rich and keeps the tax revenue flowing. The strategy for 2026 is simple. The Fed will do everything possible to crush consumer inflation, keeping wages low while secretly pumping asset inflation, keeping stocks high. If you are waiting for house prices or stock prices to come back to 2019 levels, you are waiting for a ghost. That pricing is gone because the value of the dollar that measured it is gone. Quick pause. Think of the YouTube algorithm like the Federal Reserve. It tries to suppress information like this unless we pump serious liquidity into it. If you want to help other savers find their life raft before they melt away, you need to act. Smash that like button and subscribe right now. Let's force the algorithm to let the truth flow. Okay, back to the escape plan. Chapter 3. The stealth pivot. The plumbing is leaking. So, how are they pumping the market without admitting it? Everyone is waiting for quantitative easing to be announced on the news, but they don't announce it anymore. They just do it. On December 12th, the Fed restarted a program called reserve management. Here is the research. The U.S. Treasury market, the bedrock of the global financial system, is getting illiquid. There are too many government bonds and not enough buyers. If nobody buys U.S. debt, the interest rates spike, and the U.S. government goes bankrupt. So the Fed stepped in. They are injecting roughly $40 billion a month into the repo markets to grease the gears. Think of this like a car engine leaking oil. They aren't fixing the leak, the debt. They are just constantly pouring more oil, cash, in the top so the engine doesn't seize. That $40 billion has to go somewhere. It flows into banks, who lend it to hedge funds, who buy, you guessed it, stocks. Chapter 4. Fiscal dominance, the debt trap. But why can't they just stop? Why can't they let the market crash and reset the system? Because of fiscal dominance. This is the most terrifying chart in finance. Look at the interest payments on the US national debt. We are now paying over $1 trillion a year just in interest. That is more than we spend on the military. It is more than Medicare. If the stock market crashes, capital gains, tax revenue evaporates. If tax revenue drops, the deficit explodes. If the deficit explodes, the government has to print more money to pay the interest. It is a doom loop. The Federal Reserve has lost control. They are no longer fighting inflation. They are fighting state insolvency. They must keep asset prices high to keep the tax receipts flowing. They must lower rates to keep the interest payments manageable. They are trapped, and the only way out is to devalue the currency. Chapter 5. The Melting Ice Cube. Strategy. So, how do you actually invest in this environment? You have to change how you visualize money. Most people think of money like a rock. If you put a rock in a box, like a savings account, and come back 10 years later, the rock is exactly the same size. But in 2026, money isn't a rock. Money is an ice cube. If you put an ice cube in a box and come back 10 years later, what do you have? You have a puddle. The number of dollars might be the same. You still have $10,000 in the bank. But the ice, the purchasing power, the amount of stuff you can buy, has melted away. My strategy for 2026 is simple. Get rid of the ice. Buy the freezer. I am moving my money into 3 specific life rafts that stop the melting. Asset 1, the inflation surfers. Stocks. The first life raft is equities, specifically companies with pricing power. Think of a company like McDonald's. If the Federal Reserve prints trillions of dollars, what happens to the price of beef? It goes up. What happens to the price of wages? They go up. Does McDonald's go bankrupt? No. They just change the price of the Big Mac from $5 to $8. They pass the inflation on to the customer. Stocks are inflation surfers. When the prices rise, the company's revenue rises, and the stock price rises with it. If you hold the stock, you are riding the wave. If you hold cash, you are drowning in it. Asset 2. The anchors, gold and Bitcoin. The second life raft is finite scarcity. This is gold and yes, Bitcoin. Why? Because these are the only 2 assets on Earth that a politician cannot print. When the Fed prints $40 billion a month, they are increasing the supply of dollars, but they cannot increase the supply of gold. So, simple math takes over. It takes more of the plentiful paper dollars to buy the same scarce gold. I don't own gold to get rich. I own gold to be an anchor. It stops me from drifting away. Asset 3, the magic trick. Fixed debt. The third life raft is the most powerful one. Long-term fixed debt. This is usually a 30-year mortgage on a rental property or your home. In an inflationary world, debt is a cheat code. Here is the magic trick. Imagine you borrow $100,000 today to buy a house. That $100,000 represents a lot of work. It's hard to earn. But then, inflation hits. The government prints money. Wages go up. Eventually, the dollar becomes worth less. In 10 years, that $100,000 payment will feel like nothing. You are paying back the bank with cheap, melted dollars, but you get to keep the house, which has doubled in value. Inflation literally pays off your debt for you. Conclusion. Don't be the victim. The great disconnect is a wealth transfer. It transfers wealth from the saver, the ice cube holder, to the investor, the life raft owner. You cannot stop the Fed. You cannot fix the economy. But you can choose which side of the transfer you are on. Don't hold the ice. Buy the boat. Thanks for watching, and I'll see you in the next one.